So, on Wednesday, the Federal Reserve finally made their first interest rate cut in 4 years. They cut interest rates by 50 basis points or 5%, a lot larger than what most banks expected. So what does it mean for the market and for you? Let's find out in this video. As we all expected, the Fed finally cut interest rates. Most banks actually predicted that they would cut by 25 basis points, but if you look actually at the future market and the CME future market, there was a 60% probability they would cut by 50 basis points or 0.5%. So, the fact that they cut by that amount means that most market participants actually expected it. But what's interesting is that initially after the cut, the market didn't go up. The market actually went down. So maybe people were thinking, oh, the last time the Fed cut rate, the market crashed, right? So they sold everything. But the next day, the market roared back and had a huge gap up actually, because people started maybe thinking, wait a minute, cut rates, good, right? And they started buying back like crazy. Bear in mind that they cut rates from 5.5%, which is the high end of the range, to 5%. So, based on history, the Fed funds rate is still relatively high given that the inflation has now come back down to about 2.5%, moving towards the goal of 2%. So a Fed's fund rate of 5% is still very restrictive. The eventual goal for the Fed is to bring the rate down about 3%, which will take about 1 or 2 years depending on the incoming data. Understand that the end goal right now for the Fed, and again, could change anytime, but the end goal right now for the Fed is to, by the end of the year, they plan to have 2 more cut rates of 25 basis points each, or 0.25%, how you want to call it. This means that the range of the rates will come down to 4.5% by the end of this year, and by the end of next year, it will come down to 3.5%. Eventually, by 2026, it should go down to 3%. Now, with rates coming down, this isn't a great news if you have a lot of money in a savings or a time deposit account because your interest rate will be dropping. However, this is great news if you've been buying dividend stock and REITs as they have come roaring back with lower interest rates. This is actually very bullish for stock as well, obviously. People often get confused because they read one article and that say when the Fed cuts rates, stocks drop and crash. And then they read another article that say when the Fed cuts rates, stocks go up. So which one is correct? The answer is both are correct. It depends on the environment in which the Fed cuts rate. If you look at the history, every time the Fed cuts rate because the economy is in a recession and they cut to save the economy, that is usually related to a market crash. However, there are also many instances where the Fed cut rates while the market was an all-time high, like now, and the economy was still very strong. In this situation, they cut rates not to save the economy, but to normalize the interest rates. When rates were taken from 0 to 5%, that was an abnormal situation because of a high inflation. But now, they are normalizing interest rate, which is very bullish for the stock market, especially in certain sectors moving forward. That's why the market realized in this morning after the cut, and the stocks came back up. People hear things like, oh, when the Fed cut rate, the market will crash, or oh, a recession is coming, or there is an inverted yield curve, or elections are coming now. When people listen to these narratives, they get nervous, and they sold out and they freak out. Many people freak out when they saw the market go down, like Wednesday, and they sold their stock. Worst case, even, they shortened the market. And the next day, when the market rebounded, they missed out not only on those gains, but actually even worse, they face huge losses from shorting it. So the lesson I can give you is never short the market when it's in a bull market. How do you know it? But how do you know it's a bull market? So it's simple. When the market is above the 200-day moving average and the 200 days sloping up, it's a bull market. When the 50-day moving average is above the 150-day moving average and they are both sloping up, that's also a bull market. So, what happens to the stock market after the Fed first cuts interest rate? As I said, it depends on how the economy holds up and how it was. If the economy continues to grow like it is now, rate cuts are bullish for the stock market and for any other market. And there are a few reasons for this. So first, as the Fed cuts rate, long-term rates come down, weakening the US dollar. A weakened US dollar is great for the US company in the S&P 500 for two reasons. US product and services become more competitive and cheaper for foreigner markets, leading to higher sales. So when companies, for example, like McDonald's or Apple bring foreigner earning back to the US, they get more dollar when the dollar is weak, boosting their revenue and profits. So basically, euro converted to dollar, more dollar, you know? Secondly, when the rates come down, companies can finance their operation more cheaply, which fuels expansion and is good for the business and the market. So as long as the economy holds up, the stock market could go up another 15% or whatever over the next 12 months. However, if the economy falls into a recession, stock could also go down 15% in the same period. So, but unfortunately, no one can predict a future, no one can predict a recession, not even the top economists like Warren Buffett or whoever. So recession, unfortunately, are typically declared well after they started. The only thing you can do now is watch the price action and the market. As long as the market is making higher highs and higher lows, the bull market is intact. But if the 50-day moving average crosses below the 150-day moving average and both slope down, that could be a sign of a bear market, which I doubt will happen, but anything is possible, and this could lead to a recession and a market crash. If you're unsure what the 50 days and the 150-day moving average are, I'll explain them in a moment when I show you the charts, okay? Now, let's look at what happens in the months following a Fed cut rate when the economy stays strong. This is a chart showing from 1967 to 1998. So historically, 3 months after a rate cut, the market is up 10%. 6 months later, it's up 12%, and after a year, it's up 15%. So while we can't predict a recession with certainty, we can look at indicators to measure the current strength of the economy. For example, the Fed GDP now estimates real GDP growth in real time. So as of now, GDP growth for Q3 is forecasted at 2.9%, which is still very strong. People were initially worried because GDP decelerated in Q4 of last year and Q1 of this year, sparking recession of fears. But Q2 surprises everyone with a 3% growth, and Q3 is currently projected with a 2.9%. Now, while some industries are in recession, like durable goods, autos, and housing, we are not in an overall economic recession. With the recent rate cut, we should expect auto and housing sales to rebound since they are the most rate-sensitive parts of the market. And we can also look at the earnings per share, EPS forecast, to get an idea of how companies expect to perform. So according to the briefing.com, this chart that we have in front, the S&P 500 earnings per share estimated for 2024 is $240 plus 55 cents. For 2025, instead, the earnings per share is expected to grow to $276, and by 2026 is projected to reach $311. This is the chart above. So in other words, companies are expected to grow earnings over the next few years, and as they earn more, stock prices should rise. The sector, unfortunately, that they suffer the most are automotive and the housing market, which are currently in recession. Actually, hopefully they will be out of recession soon. Then moving on, okay, this is the chart of S&P 500, BBK, EWM. So let me explain you. Some people argue that the stock market is in a bubble and is too expensive. But if you look at the data, it's not really. So from 1950 to 2019, when the inflation was below 2.5%, the average PE ratio of the S&P 500 was 21 times earning. Right now, PE ratio is exactly 21, meaning that the market is fairly priced. It's not expensive and not cheap. You can also look at the PEG ratio, which divided the P ratio by the earnings growth rate. So over the past 10 years, the average PEG ratio has been 1.5%. Currently is 1.49, which is below the 10-year average, meaning the market is not expensive based on this metric either. So in summary, I really remain bullish for the next 6 to 12 months. As interest rates come down, small to medium-sized companies with more debt and less cash should benefit the most. Since the pandemic, in fact, small cap have underperformed large company, but as rate drops, small companies should catch up. That's why I'm personally invested in the BBK small cap ETF, and I think it has a good chance to outperform the S&P 500 as rates normalize. And the same is for EWM, so they are the same, small cap company ETF. Another sector to watch is consumer discretionary, which historically outperformed the Fed cuts rate. Stocks like Amazon, Lululemon, Nike could rebound strongly. Although I'm bullish in the medium and long term, I'm a bit cautious in the very short term because seasonality is one of the main reasons. September is typically a bearish month, and the last 2 weeks of September especially are historically the worst. Combined with some technical patterns, this makes me cautious in the short term actually. So by the end of October or early November, we should see a strong rally in the markets as we often do during an election year, regardless of who wins. So for example, here you can see the weekly performance. So you see that real estate is still almost the last one, consumer defensive is the last one, and the first one now is consumer communication services, 3.52, energy, consumer cyclical, financials, you see, because obviously the rates are coming down, and you can see what I say before, the percentage in each sector. But now, while some industries are in recession, exactly like durable goods, autos, housing, we are not in an overall economic recession. We should expect house sales to rebound since they are the most rate sensitive parts of the market, and also every sector like automotive where you actually need to finance to get money to get the goods that you want to buy. Ecco, you can see here the worst part of the month is actually the last 2 weeks of September, which tends to be most bearish in this chart. You can see Fundstrap give us this chart, and combined with some technical patterns, that's why I'm not so bullish in the short term. So finally, let's take a look at the charts. So this is the SPX, SP 500. So for those who are new to technical analysis, the blue line is the 50-day moving average, and the green line is the 150-day moving average. As long as the blue line is above the green line, we are in a clear uptrend. Bear market is confirmed only if the blue line crosses below the green line and both start sloping down. So we are very far from that right now. As you see, the 50 days is above the 150-day moving average, and they're both sloping up, so the bull market is intact. So looking back at history, the last time we had a bull to bear market reversal was in 2022. And you can see that when the blue line crosses below the green line and both slope down, the bull market reverses into a bear market. And when the blue line crossed back above the green line, we were back in a bull market. I'll show you after in the next chart. So right now you see the market made a higher high in July, pulled back, and then made a lower high. But recently we made a new high, breaking above the previous high with an intraday high of 5,733. So I truly think if in the next couple of days the market closes below 5,669, you see there is a bullish pin bar there, we could be seeing a bull trap pattern, which could be, if in the next day the market closes below that 5,669, that pin bar, that bullish pin bar was a bull trap, which could lead the market to pull back down to the 50-day or even the 100-day moving average before the rally of the year end. But if the market holds above 5,669, which is what we are seeing now actually, this will mean a strong breakout pattern which could take us higher and higher, and we will still go up and down obviously, but the bull market will be even more confirmed. So as always, stay invested in high quality stocks, high quality company, and actually let me show you what I just described before. So you see this is the bear market when the blue line crosses below the green line, the 50-day moving average crosses below the 150 moving average. You see this clear uptrend and then the downtrend. And here you can see the uptrend where the 50 crosses above the 150 and both sloping up, and again the clear uptrend. And again, here is what I explained you before about the pin bar. So I truly believe now we're in a bull market. Again, don't take short trade now until at least the first week of October, I would say, because it's very choppy, will be very choppy just for seasonality. But if you want to correlate this to real estate, for example, I truly believe that real estate is a lag factor, even on the early or in the later side, like let's say 6 to 9 months after the S&P 500 behavior. So I truly believe we bottom in real estate. These new things about the election is another catalyst for fear, and I think we are going to an uptrend. Be the market be with you, as the market be with you, and this is Emanuele Fioraserant. I am happy to give you market update not only in real estate but also in finance, because again, if you do not fully understand finance, you will never fully understand real estate, and you will never fully understand the economics and many other sectors. So we always try to take smart guesses and call us, and here we are. Thank you. Bye.